You want to know how traders actually make money with hammer candles? Let me fix the biggest mistake hurting your trades right now. Most traders see a long wick and instantly think, that's a reversal. Wrong. This is why you keep buying bottoms that aren't bottoms, catching falling knives, and watching the market melt straight through your stop. But the truth is simple. A real hammer candle can make you money if you know what makes it valid. And if you don't know what a wick is, or what liquidity means, or what a doji even is, don't scroll away. This is exactly the channel for you. I break everything down simple so you can screenshot it and understand it. Give this video one chance and subscribe if you're serious about locking in. Let's put the real definition of a hammer candle on the whiteboard so there's no confusion. A hammer candle is a bullish rejection candle that forms at the bottom of a downtrend. It has a long lower wick, usually 2 to 3 times the size of the body, and a small real body near the top. This candle forms when sellers push price down, take liquidity, and then completely lose control as buyers step in and force price right back up into the upper part of the candle. So at its core, a hammer is not a pattern, it's a failed sell-off, a liquidity grab, and a shift in control from sellers to buyers. Screenshot that. A hammer only matters at the bottom of a move, not in the middle, not at the top, not in sideways chop. This is a bottoming signal. If it's not at a bottom, it's not a hammer worth trading. The lower wick must be long 2 to 3 times the size of the body. That wick is the liquidity grab. It shows where sellers got trapped and buyers absorbed every sell order. For a hammer to be valid, it needs to close in the upper 25% of the candle. That's your proof buyers didn't just react, they took control. Step 1 is obvious. Spot the hammer at the bottom of a downtrend. Skip every hammer and chop and every hammer near the highs. Never, ever enter on the candle itself. Wait for price to break above the hammer's high. This is where the real shift in order flow is confirmed. The safest, most profitable entries happen when price pulls back into the hammer's wick or the open-close zone. This is where institutions stack their orders. This is where you get your discount entry. Your stop loss goes below the wick. Simple and clean. Your take profit targets are previous swing highs or major imbalances above. Remember, you're trading a shift in control, not just a picture. That's it. That's your hammer candle system. Screenshot it and save it. If this made hammer candles easier to understand, subscribe and lock in. I'm breaking the entire market down signal by signal so you can finally trade with clarity.